Tesla earnings report. It was a spectacular performance by Tesla by all ramifications. You can't see that report and not love the company. And this is the surprising thing about Tesla. We've seen the stock is very volatile. So you have some of these near-term headwinds that have affected the company that send the stock price crashing. But the company has stuck to its strategy, day one strategy. There's nothing new, actually, if you've been following this company for a very long time. There is nothing new in this report. This is who Tesla has been all these years. To the report itself, we saw a slight decline in revenue. Revenue dropped by 1.17%. Compared to estimates, they posted a revenue of $25.2 billion. But where the company made its mark is in EPS, earnings per share, outperformed estimate by 20%. EPS came at $0.72, 0.72 cents compared to 60 cents estimates. EBITDA came at 4.6 billion, outperforming estimate by 20.05%. It was estimated that they will post an EBITDA of 3.89 billion, but the company ended up delivering 4.67 billion in earning before interest, depreciation, and amortization. And then if you drill deeper into the result, you saw automotive revenue go up by 2%. And this is understandable. At some point, Tesla started to cut prices because we've had headwinds, a lot of headwinds in the EV space. You had higher interest rates, and so people were not getting the financing they needed to buy these Tesla cars. You also had trade wars that impacted demand, particularly in China, and globally, EV demand has struggled. So most EV companies, pure play EV companies, have seen a slowdown in demand over these years. But what Tesla did was to reduce the price of their vehicles. And at the time they took that decision, what most analysts expected was that it was going to hurt their revenue, which from this report you saw their revenue grew just by 2% year on year compared to third quarter of 2023. We just had a 2% growth in revenue. But where the magic happened was in cost. The company delivered in terms of cost efficiency, and you saw that show up in their gross margin. Gross margin went up to 17%. Tesla used to do a gross margin of around 20% gross margin before declining below 15% recently, as we had all of these headwinds affect the company. But now gross margin is growing again, and we expect in the coming months, as the company consolidates on all of its cost efficient measures, we expect the gross margin to ramp up back towards 20%. It's the Cybertruck also performed well within the quarter. According to the report, the Cybertruck is now the third best-selling EV in the United States. And then we saw contributions from self-driving vehicles, $326 million in revenue. The company delivered 462,000 vehicles in Q3, which is an increase from a 6% increase from Q3 2023. In terms of outlook for next year, the Musk actually said in the earnings call that he expects revenue to grow at between 20 to 30% for next year. That is below expectations we had 3-4 years ago. But if you have kept track with what is going on with the EV market, you see that if they're able to grow at 20% even next year, it will be a very spectacular one for them. You can't help but to be very excited looking at the performance of Tesla. So how did they deliver on this, really? That is the question. because there's hardly an EV company in the world that is profitable. I think Tesla, Musk says something like Tesla is the only EV company that is profitable in the world. I can't validate that claim, but if you look at the EV space generally, most of the EV stocks are struggling big time. Rivian, Lucid, Neo, Xpeng, all of these companies are struggling. Their share prices have mostly been down this couple of years. And that speaks to the level of demand we are seeing for EVs. But the unique thing about Tesla is that I don't really see them as a pure play automotive company. Tesla is something of a hybrid between between automotive and software. Is both a car manufacturer and a software company, and that is what has helped the company remain profitable all these years. Tesla has been profitable for a long time now and continues to be profitable. And one unique thing they've done that sets it apart even from other car manufacturers is that Tesla focus on their production plants. They focus on making their production plants a lot more efficient than the likes of GM, Ford, Honda, and the traditional auto manufacturers. Tesla has plants in the United States serving the North American market. They have another plant in Berlin, Germany, serving the Europe market. And they also have a plant in Shanghai, in China, serving the Asian market. So with these strategic plants, what the company is able to do is to cut down on stuff like tariff. Of course, if you're sending cars from US to China, you're going to pay tariffs. But if you already have a plant in China, you're going to boycott those tariffs and other duties that comes with export. So he's able to boycott all of those. And even the trade wars that we've seen between Europe, America, and China, they're able to manage it better. And their plan, they're focused on making their plan more efficient with the sort of technology they have. So the company has positioned itself to be the leader in the EV space, and they're the leader by a wide margin. It's not even close. No company comes close to Tesla in terms of what they have done in the EV space. And then you look ahead, you expect exchange rate to start coming down in the coming months as the Federal Reserve starts to implement rate cuts. As exchange rate goes down, you expect the demand for Tesla cars to go up again as people start to have more access to affordable financing. Because if you want to get funding for a car, you look at the monthly payment, and the monthly payment has interest rate has a consequence on the amount you get to pay at the end of every month. So with lower interest rate, most people will be encouraged to actually get financing for Tesla. And then we finally saw clarity in terms of the cheaper model EVs, which has been the kind of the gray area for investors. Finally, the company committed to delivering on these cheaper model EVs come Q1 2025. And it's going to also be a game changer in terms of the company being able to grow revenue. If they have these cars below $30,000, it's going to actually ramp up their sales. And to date, the company has delivered 7 million vehicles, and that is very, very impressive for the EV market. And then again, you saw what they are doing with the robotaxi. For me, it's like the game changer. The ability to deliver on the robotaxi and their FSD, which is a full self-driving autonomous vehicles, will actually transform a lot of industry, the e-cab hailing industry, and then of course just the whole EV space. If they're able to get the approval, they're projecting to launch the robotaxis come 2026. So it's going to really be a game changer for them, and the company has just positioned itself to be a leader in this distinct space. Speaking of the e-cab hailing business, the robotaxi, the FSD, and then the regular Cybertrucks, their Y model, the Y model, which has been the best-selling EV worldwide. So the company has positioned itself attractively. If you compare their price to earnings ratio with the likes of General Motors, Ford, Tesla would appear expensive at 73.75 currently, compared to GM that has a PE ratio of 5.5 and Ford that has a PE ratio of 11.53. But I think comparing with these companies is just because you don't know which other company to compare them with. Tesla is not, as I said, a pure play automotive company. They're a hybrid company that combines EV and software, which sets them apart. So the sort of stuff you see that could potentially affect the revenue and the profitability of a pure play automotive company is not affecting Tesla. They cut down on price, and yet the company has remained profitable. So basically, they are taking control of the things that is within their circle of influence, and they are attractively positioned. Okay, so if you look at the stock performance in the last 3 years, Tesla has actually underperformed the S&P 500 by a wide margin. In the last 3 years, Tesla has returned negative 21.2% compared to 33.28% from the S&P 500. But with the result we saw last week, the share price went up 23% for the week and 8.3% year to date. But as I said, the company is positioned to grow their revenue in the years to come. I think we've seen the worst of the interest rate. We've seen the worst in terms of the declining EV demand, especially in China. And actually, sales are beginning to pick up in that region for Tesla. And now that we have in sight the cheaper EVs coming in Q1 2025, I think the outlook for the company is a lot more positive than it was a couple of months back. So barring a resurgence in interest rate, barring a black swan event and let's say an outbreak of a war or stuff like that, you expect this company to continue to outperform. The result has been, the rebound so far has been impressive, and I expect the company to push towards $300 in price. But as I said at the beginning, Tesla is a very volatile stock, and if you're looking at short-term rewards, I don't think this is the company for you. If you're investing in this company, it should be for at least the next 5 years. You're looking at what happens with the lower model vehicles next year. You're looking at what happens with the robotaxi comes 2026. So you're actually investing for the future, not for the immediate. So if you're a long-term investor, this is a stock you look at to decide whether you want to add to your position if you don't already have it, or continue to average down or average up, as the case may be for you.